do India valuations therefore stay elevated if indeed global flows were to come in and India's 401k moment, as you know, many have written, kind of stays true, that the Indian domestic retail investor continues to buy, right? So do valuations go up and reach bubble territory, or do you reckon maybe second primary market issuances, block deals, etc., kind of take center stage, or do that, or is it that the flows will be measured from the foreign guys because of the valuations?
So Neeraj, first point I will make is that India's valuations are not rich.
Okay.
Let us understand. Yeah, let us understand this. Okay, I think when we went into flexible inflation targeting, we eventually dampened inflation walls. India's inflation walls are amongst the lowest in the world. As a consequence, interest rate walls are low in India. And as a result of that, future growth volatility is going to be a lot lower than it has been in the past, both absolute and relative to the world. Equity markets thrive on low growth volatility. As an equity investor, the variable that I have least control on is future growth. If I am told in advance that that growth is not going to move around a lot and is far more predictive, I'm going to pay up for stocks. So I think we should abandon this idea that Indian stocks are expensive. They're not. Adjusted for future growth volatility, Indian stocks are not expensive. Then if you look at, Indian yields, bond yields versus equity yields, this is a lot cheaper than India has been in the last 4 years. I mean, India got cheaper than this, stocks, only during COVID. Because remember, Indian 10-year bond yields are 6.2. And if you take the equity multiple at 20 times forward, then it's 5%. Our equity yields are very close to our bond yields, and it's the opposite in the US, where the gap has been widening. In India, the gap has been narrowing in favor of stocks. If you look at Nifty in gold terms, I like to look at that because it's a very good long-term variable. The Nifty is a lot cheaper than it has been over the last 24 months. So stocks on most count, to my mind, are not expensive in India. Now, a lot of the foreign money is what I classify as tourist money. It doesn't actually go into granular details like this and just looks at headline P multiple, which is the worst way in which you can evaluate a stock's value. P is the worst metric to use, but it is very commonly used because it's very easy to use and it's very easy to compare over time, and you can plot really fancy charts and make it very convenient, and therefore it gets abused. And when you look at it on that metric, India looks like, wow, it's expensive, but it's not. And that is why India is doing so well. This market has done well, not only just over the last, say, 24 months, but it's done well over the last 3, 5, 7, 10, 15, 20, 25 years. It has beaten almost every large market on the planet, because you can't, if you are rich, the stocks are not rich relative to what India's growth has been, and relative to what the return on capital that Indian companies generate, which is the second point I'll make, that Indian companies are very frugal with their balance sheet in large part, and therefore deliver superior return on capital. And that's what equity investors care for, which is return on capital, because that's what return on, making money on stocks is all about, is what return I can generate on my capital. So I think India is okay. I think foreign investors will recognize that and will up their stakes. But the problem here is something different, Neeraj. The problem is who's going to sell to them. And that's where the 401k movement comes. We wrote about this like 10 years ago. And there was total disbelief about what was going to happen with domestic investing. We wrote a last large note around this 6 years ago. And we concluded that this is a maybe multi-decade story. Households have pivoted and will continue to raise their equity holdings. And we're only at 7-8%. We could easily go to 20%. So yeah, that bubble situation is possible, but not on a 12-month time frame. I would say on a multi-year basis, we could arrive there. The NASDAQ did go into bubble territory as a consequence of all the buying that US households did over 20 years. So we're still early in this, but yeah, we could get there. It's a possible scenario. So foreigners can only buy if domestics start selling in earnest or corporate issuances begin in India. And then they'll have space to buy. So that's one of those two things have to happen. I think the former is less likely. The latter is more likely. So that's what they're going to get. They're going to get a lot of supply from Indian companies over the next 2, 3, 4 years.